This is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott. Andrew Young is off for today. Last week, we talked a lot about Ethereum and the move to what they're calling ultrasound, the idea that basically the Ethereum supply is shrinking because a portion of the fees that are used for gas are actually going to a burn address. And as a result, the revenue is accretive to existing token holders. And this got us talking a little bit about the idea of valuation and how you should think about how to look at crypto assets as investments. Now, a lot of this has to do with the underlying technology and how it's growing and how it's being adopted and the economy that's happening inside of blockchains. But I think it's possible to apply some traditional analytical rigor and some analytical methods to understanding value. And so this week, we're very fortunate to have a special guest on the podcast, Sam Andrews. Sam, I've known for a couple of decades. He's a Toronto guy like myself, but cut his teeth for almost a decade as part of the investing team at Blue Mountain Capital, where he was doing fixed income and equity analysis. Blue Mountain Capital is a New York-based hedge fund with over $22 billion in assets. He pivoted a couple years ago to the crypto space. We're going to get into the reasons for that shortly, but is now currently the author of Crypto Clarity, which is an in-depth research newsletter on protocols and crypto markets, focused on understanding the business and investing case for Web3 and for crypto assets. So I think Sam is a perfect person to talk to about this subject, to really dig into what are the valuation methodologies we can use, what are the things we should be looking at to understand crypto assets as investments. So Sam, thank you very much for joining us.
Hey, Alex, thanks for having me.
So how does a Wall Street hedge fund guy become a crypto researcher? Tell us about that journey.
I'll tell you about the journey. It's a bit of a fun one. I think, as is apropos for a few things, it's gradually at first and rapidly in the end. And so how gradually it first happened, even kind of going back to 2017, is when I first started kind of cluing into crypto. And that was really kind of Bitcoin and Ethereum for me at that point, and kind of reading the white papers and sitting kind of in financial markets and in the investing world, saw both the promise of Bitcoin as a potential revolutionary monetary form of money and the potential for Ethereum, particularly the programmable aspects of it, as just this fascinating technology that could really revolutionize how assets are exchanged. And so that was a bit of a kind of light bulb moment for me, and I ended up buying both Bitcoin and Ethereum at the time, almost more as kind of like portfolio positions, where I thought, well, this has huge prospect. It probably warrants a small position in my overall portfolio. And so did that. And lo and behold, a few years later, it ended up being worth a whole lot more. And that's when I started looking at it in a whole lot more detail, especially Ethereum. But it remained a kind of hobby and interest for many years, kind of a side project. And then a couple of years ago is really when I started spending all my time on it, and all my kind of hobby and interest hours started being spent on crypto. And part of that was really revolved around kind of three things. It was one, it was just super fun of like learning a ton about this new technology. And second, it felt great and being valuable, being useful, particularly kind of my prior skill set. And third, kind of developing a thesis around crypto and what it could become.
Yeah, fascinating. And so you mentioned that, Ethereum is an area where you're focusing on recently, and people I'd encourage you to check out Sam's newsletter. You put together the 2022 a year in review, and then later the Ethereum Q4 state of the network. So I want to talk about this, a couple of things. One is the idea of doing these quarterly reports on different protocols reminds me a little bit of like how a sell side analyst, or in your case, a former buy side analyst, might do a periodic report looking at the state of any individual company, right, or equity, and a lot of the metrics that you use apply to that. So before we get into that, why is it, and maybe this characterization is incorrect, but you mentioned that Bitcoin, Ethereum, but Ethereum is the thing where you seem to be spending more time doing your analysis. Like, what was it specifically about Ethereum that attracted you so much?
So what particularly attracted me about Ethereum, one was the programmability of it. It really pioneered like smart contracts, right? And my thought was, I had a real interest in understanding the infrastructure of how a lot of this technology was being built, right? And so starting with Ethereum as the first programmable blockchain, let's understand Ethereum and the kind of ecosystem around that. And then subsequent to that, there were a number of what are called like alt layer 1 blockchains that developed to address some of the particular challenges that Ethereum had. So Ethereum for me seemed like a really good starting point.
Mm-hmm. And on that topic, you know, in the report on Ethereum, you mentioned how Ethereum sort of kind of emerged from the 2022 experience stronger, really, almost than when it entered into it, and that this alternative layer 1 thesis, while still alive and well, and there's probably going to be lots of demand for that, doesn't seem to have knocked it off the pedestal as the number one protocol for doing the kinds of things you're describing, which is launching applications and smart contracts and generally doing, you know, more general purpose blockchain applications. Why is that, do you think, like looking back on the past year?
Yeah, so I want to highlight a few things about Ethereum, particularly this state of the network that you mentioned. And every quarter, I kind of update that state of the network. Think of it almost as like a quarterly results for Ethereum. Yeah. And there's two things that particularly came through in the Q4 results. One is the kind of key metrics of Ethereum continue to deteriorate. They're decelerating, right? If we look at usage and revenue, are decelerating. So, and that's a problem. We can talk a bit about why that is. You alluded to some of the reasons. Is it
that the growth rate is slowing, or is it that in certain instances the metrics that you're looking at are actually getting worse rather than the second derivative of the rate of progress declining? Is it or is it both?
It's both. So depending on the metrics you look at, they're decelerating. So for example, like unique address growth, like that's decelerating. But then if you look at like daily active addresses, that is declining. So those are, and so the second thing that is highlighted in the Q4 results is Ethereum has become the first profitable blockchain. And that is a really big deal, right? It's effectively the only profitable blockchain. And that is a huge deal, particularly because it ensures the security of the network, right? And it's my view that having a security in blockchains is critical, and how you ensure that security is through a form of economic remuneration for the validators, right? And if they're being issued tokens that have real intrinsic value because they're profitable, then the incentive mechanism to continue validating remains. If validators are being remunerated in a token that has no real value other than speculation, then eventually those validators will stop validating that blockchain because there's no economic incentive. And once that happens, then the risk of the entire blockchain crumbling because its key feature, its security, is no longer supported by validators.
Mm-hmm. Yeah, it's interesting. You know, like Bitcoin has almost a similar kind of mechanism in a way with proof of work mining, which is that, you know, stakers in Ethereum are staking assets, tying them up, so to speak, you know, so that they can't use them for something else or use the money for something else. In exchange, they're being compensated. And similarly, like with Bitcoin miners, you know, they're tying up big computing resources to support this network. And they're tying up those resources that they could otherwise, you know, put towards something else. And so both groups have a strong incentive mechanism. Now with Bitcoin, it has this sort of self-correcting mechanism, basically, where if a bunch of miners come offline because they're unprofitable, then the hash rate declines, which makes the difficulty a little bit less severe, which means more miners can join back in. But it does presuppose that the price of Bitcoin, you know, if not stable, that it will continue to, you know, be valuable essentially, and then that value is based largely on utility or how widely held it is, more than anything else. And Bitcoin, a lot of people think of as ultrasound money, because it has a pre-programmed rate of growth to 21 million, tokens. And right now it's at 18 and a half or 19 or so. And it can't be controlled by a central authority, but it is still seeing issuance, right? Like there's still sort of dilution, so to speak, to existing Bitcoin holders in the sense that there are going to be more Bitcoin. And see, what's super rare about Ethereum is that not only is it generating protocol revenue that seems to exceed the issuance, but actually a portion of that protocol revenue is going to actually buy back tokens, what they call burning in Ethereum, but really it's sort of like a buyback, right? And I'm wondering, maybe this is something that popped out to me immediately because I've got, I guess, a background as well in traditional equity analysis. But basically what Ethereum is doing is a combination of being not only profitable because of underlying usefulness, which is helping to guarantee the security of the network, but it's actually shrinking the float. And so in a way, it's almost like what it's doing is accretive to earnings in a way that I think it makes it even more sort of unique in a way compared to other blockchains. I'm wondering, have you thought about that, or used that analogy before?
Yeah, so there's a few things going on at Ethereum from kind of an economic standpoint that are all like relatively new to Ethereum, and as a result of that, relatively new to kind of the crypto ecosystem overall. So one, you have this like buyback that you're referring to, which was introduced. The EIP 1559 is kind of this burn mechanism that was introduced in the summer of 2021. And then second was the conversion to proof of stake, right? And the conversion from proof of work to proof of stake meant that the cost of operating Ethereum declined by about 90%. And what I mean by the cost of operating Ethereum, that is the issuance of new tokens, right? And those issuance of new tokens previously went to miners, now they went to validators. They're there to ensure the security of the network. And so by a cost declining by like 90%, and as a result of the conversion from proof of work to proof of stake, and now you have this methodology through the burn mechanism to effectively buy back tokens, the chain becomes profitable, right?
Yeah. Right. So those are the two things that have happened here. And in a way also, like I think of the move to proof of stake, which we've talked a lot about. The merge was I think we did probably 4 merge episodes last year, including, in the immediate aftermath with Anthony Diorio as co-founder of Ethereum. And in a way, I think the merge was kind of overshadowed by the news events and the collapse of FTX specifically. But it is a watershed. And I think this EIP 1559, which you got to hand it to these blockchain people for the worst naming conventions imaginable. But anyway, this thing EIP 1559 is, I think, not as well understood, but perhaps just as impactful. But the key thing I was going to say is that the move to proof of stake eliminated not only the cost structure you're describing, but the opposition to blockchains being wasteful, because ultimately proof of stake in Ethereum, at least, doesn't really use much more energy, if any more energy, than a data center running traditional software application. And to me, that's a really big tailwind for usability and adoption, which in turn fuels all of the things that we're talking about, right? The reason Ethereum is able to commit a portion of transaction fees to buying back its own token, burning is the term of art in crypto, is because the network is inherently useful. There are fees to begin with. If people didn't want to use the network to run applications or do stuff, then the fees would be negligible. And in fact, they were for a period of time. So it's very utility that makes it possible to not only generate revenue, but to be able to like keep the float stable or even have it decline.
Yeah, like so just keep going on that thread. In addition to this, like there's 3 like economic drivers to Ethereum.
Okay.
Right. So one, we have this like burn mechanism, right, in the buybacks. Secondly, you have the earnings yield, right? And So the earnings yield is like the earnings that get driven to stakers. And third, you have your staking yield, right? So these are three forms of like value that accrete to token holders, right? Two of those specifically accrete to stakers, right? And those two specific ones are the earnings get paid to stakers, and then the staking yield also gets paid to stakers. And those three things are what drive the value of owning Ethereum. And then, that's on those three things are driven by ultimately the use cases for Ethereum, which drive revenue.
Right. So you've talked about a couple of things. I love the idea of like an earnings yield for crypto. What are some of the other metrics that you like, if you were to say fundamental analysis or like value-based analysis, like in the Graham-Dodd tradition, are there any other things that you look at when you're analyzing specific protocols?
Yeah, it depends on the stage of the protocol, right? So Ethereum is kind of in its own realm from a valuation standpoint, because a lot of the metrics are a bit more mature, right? Mature in the kind of blockchain concept, right? But there's a whole bunch of metrics we can look at for a variety of different protocols that kind of fit maybe three different realms. So kind of at the earlier stage, you look at things like the number of developers, the number of GitHub commits. At maybe a slightly later stage, you can be looking at things like usage, so number of wallets, number of users, how frequently they're using it. And then at a later stage, you can be looking at things like revenue and costs, right? So those are metrics that lend themselves to more traditional, call it value or like growth investing.
Yeah.
And ultimately those, what value or growth investing is just looking at tangible metrics to derive the value of an underlying asset, right? And that is becoming increasingly important in crypto, and is becoming increasingly important as the market kind of matures and evolves and more investors kind of enter the space to deploy capital, but then also existing investors within the space are trying to differentiate, the value of one protocol versus another.
Right. And I feel like at the same time as in equity analysis, a lot of times when a story or when a project is new and we're using some of these, they're tangible metrics, things like number of developers or GitHub commits, but they are metrics that point to some future growth, right? You're seeing value being pulled forward, I think, very early in some of these early stage projects. And almost as things start to convert from growth to what you'd consider, more of like not a late stage, but when they start to actually harvest revenue and so forth, that the valuations actually decline. Ethereum, I think, is probably an exception to that rule, but I think it's still undervalued relative to where it is at and the position it plays. But a lot of these DeFi protocols that had a lot of success in 2021 and 2020 have matured, and maybe their TVL has gone down, and in some ways they're actually slowing down, but the value of their tokens has been absolutely just crushed. And I'm wondering if you think about that at all, and if you spend any time looking at those names, the so-called blue chip DeFi, things like Uniswap or Compound, may still be very useful. I think Uniswap's still doing over $500 million a day in daily volume and lists thousands of different trading pairs, but its token is doing awful. And I'm just wondering how you think about that.
Okay, there's a few things to think about from like kind of crypto valuation, right? And let me just put things in context a little bit more. So one, it's very much an emerging body of research, right? There's no set way of how to value these things. And like, I spend a lot of time thinking about this, and I think it's particularly useful to kind of forge ahead on how to value crypto. But valuation heuristics are only useful if other people are actually using them, right? So you can develop the most intellectually sound way of valuing a crypto protocol, but if no one else is using it, it's actually irrelevant, right? And valuation heuristics are a relatively new thing, even in traditional financial markets, right? So you reference kind of securities analysis, this pioneering book by Graham and Dodd, it was published in the 30s, right?
Yeah.
But value investing didn't really take hold until like the 80s, right? And in the interim, there was this period of like the Nifty 50s where the Nifty 50 was like these 50 stocks that like you should own regardless of any form of valuation, right? Because they were operated by great CEOs with good pedigree and were generally nice guy. Totally disassociated from like the underlying fundamentals of the business, right? And it wasn't until the crash of the 70s and then into the early 80s where like valuation methodologies started to take hold, right? And that gave birth to like the private equity industry and the hedge fund industry and eventually kind of the venture industry, right? So these heuristics take time to develop, and we've even seen that in like traditional financial markets. And some of those are starting to be applied to crypto, and some of them are relevant, others are less so. And they will also take time for like people to start appreciating them and using them. And until they do, they remain a bit irrelevant.
So do you view part of your role as not only trying to develop those heuristics that make sense, but also almost advocating that people use them?
Absolutely. That's a big part of like my research and my writing is to propose ideas of how to value these different protocols, right? Yeah. Some of which are kind of tied or derived, I should say, from traditional valuation methodologies, and others are a bit more novel.
Yeah.
Pardon?
No, I'm interested in that, what you just mentioned, because I'm wondering how much your training and experience in the traditional world of financial analysis prepared you for what you're doing now, and how much of what you're doing now has made you rethink some of the things you learned or have to relearn in order to be more effective in this asset class. Like, obviously it was a big help because you've got that practical on-the-job training in probably one of the more intense, and demanding environments. But then again, there's a big difference between looking at public equities where everybody does agree on these heuristics versus this emerging asset class where I think everyone's still kind of groping in the dark for just how exactly to value it.
Yeah, so maybe a few things to share on that. In terms of like carryover from like my hedge fund investing days to my, call it crypto days, there's a few things that parallel. One is like return on time, right? And the idea from like an investing standpoint that like time, generally from any standpoint, is like time is finite, right? So the hedge fund world, like you really had to be disciplined on developing the best return on time. And what that forced you to do is quickly figure out how something works and what are like the key drivers to that thing usually being a business. The second thing, which is appropriate in all like investing and is generally misunderstood across like all markets, is your returns are driven by the convergence between like your expectation and the market's expectations, right? And what I mean by that is like you have a lot of investors who are like, this is a great business or this is a great protocol, I should buy it, right? And you suggested Uniswap previously, like great protocol, right? But that a great protocol or a great business doesn't necessarily make a great investment, right? And people kind of miss that across all markets, right? And that is something that is like critical to understand. The third carryover is just being like more pragmatic, and especially my early days in investing, which were more on credit and like distress, which were a lot of the mindset there was like, how are we going to get screwed in this, and how do we prevent that from happening? And then maybe shifting in terms of like new things that are like different from crypto versus traditional investing is one. In crypto, like you need to be way more scrappy, right? In traditional investing, you've got all the information is presented to you and it's up to you to interpret it, right? And maybe at the margin, you're discovering like a bit of new information that's like your edge. But in crypto, like you need to go find all the information first, right? And that is actually surprisingly difficult. And then you need to go reward it. So it rewards research a lot more. And part of the interest for me is like, I think I can stand out a lot more in crypto than you can in like traditional investing. Second, like you need to have a better technical understanding, right? So in traditional finance, or traditional investing, if I would tell you like it's a retail business or a software business or a CPG, like you immediately know what that is. Like that business has a product, it sells that product, and that's how it generates its revenue. And then those revenues go to offset the cost of producing that product. And then the remainder of the profit, if there is any, goes to the people who own that company. In crypto, like that's not the case, right? There's a heavier lift to understand what the protocol actually does, right? And then often it's a novel concept. And then you're not even sure if even if it does generate revenue, like does the value that gets accrued in that protocol, does that actually accrue to token holders, right? And again, we can think about like Uniswap of like, this is a phenomenal protocol that's been developed, but like none of the value that gets created on Uniswap actually accrues to Uniswap token holders. So that's a kind of great example of like, this is a phenomenal protocol. It creates a ton of value, but like that value doesn't actually accrue to token holders. And then the third thing, which we kind of talked about already, is like, how do you think about value, right? Whereas like in traditional investing, it's very much a cash flow based analysis, whether that you're using your cash flows to derive an equity value or trying to infer a bond price. In crypto, you first start off as like, well, what do I actually own, right? What kind of claims do I have? Like, does it actually have value? And if so, how could I potentially value this? Which is, some of the metrics we started talking about.
Yeah, fascinating. This discussion about fundamental analysis and Graham Dodd is reminding me of a very famous Warren Buffett quote, because I think a lot of people think of Warren Buffett as like a big adherent, maybe the most famous adherent of Graham Dodd value investing. But he's someone who kind of ditched that a long time ago. I mean, he's said in the past, I'd rather buy a great business at a fair price than a fair business at a great price, right? And what's interesting is that you made the point of, people confuse a great business with a great investment, and maybe a great protocol with a great investment. But there is a point at which both of those things can converge, and where you're almost better off, looking at the protocols where there's a great there, where value accrues to protocol token holders, and where the valuation is not unreasonable, and maybe where they also have a big moat. And that's something that I think a lot about when looking at DeFi, because it's very, very different than traditional, capital markets or any other industry. Like all you have to do is offer better rewards, and you're going to siphon off liquidity from one decentralized exchange to another, unless that exchange has superior front end and a better brand and a better reputation. And then maybe that won't be the case. And then we actually saw that with Uniswap, and we're seeing it also playing out right now in the NFT space, right? Where like OpenSea initially started with a huge lead. Now they don't have a token, but the same kind of economics applied. And then all of these other NFT platforms came along and sort of offered better, lower fees or better deals for creators. And all of a sudden they were able to siphon off liquidity. So it's just an interesting dynamic at play, where you've got to sort of balance out all of these different priorities, not only the valuation or the underlying protocol, but how it creates value for token holders, and also what moat, to the extent that that is even the right way to think about it, does that thing have over the next thing. And just returning to Ethereum once again, we've talked at length about Ethereum was a victim of its own success. Block space filled up, fees went really high. People went to alternative layer ones. Those things drew a lot of TVL and transaction volume away from Ethereum. Maybe Ethereum was never able to scale in the first place, but last year they did deliver on EIP 1559. They did deliver on the merge. All of these new layer twos came about, which made the Ethereum main chain more useful as a final settlement layer. And all of a sudden it's kind of emerged on top. So all of these different things, I think, are important when thinking about the analysis of these different kinds of assets. Anyways, that's just kind of my 2 cents on the thing. You mentioned earlier that this industry rewards research, which I always think is really interesting, because on the one hand, there is no sell side producing research, and there are no quarterly reports for our public companies, but there's also all this data that's on chain. And if anything, like the raw data, there's almost more of it than there is raw data available to your average equity investor. How much of the research that you do would you say relies on looking at on-chain transaction data and other publicly available information, and how much of it would be based on, you know, some other kind of research? I don't know, digging, calling people, doing interviews, channel checks, things like that.
Yeah, most of the research is like what I would think about as on-chain research, like looking at tangible metrics, right? And that gives you an assessment of like, you know, how are things right now, and looking at it historically of how have things evolved, usage, adoption, revenues, so forth. And then also the cost structure, where you get into more looking at like future, you know, developments. That's where speaking to people within the ecosystem, developers, other researchers, of like, okay, what could this be used for? How should I be interpreting this new improvement plan, you know, regardless of what chain we're talking about? This new application that's being developed, like how could this conceivably work? That's where it becomes a bit more qualitative in the research. One thing I want to highlight as well that I think you may find interesting, you know, part of like what's interesting about investing in crypto, and put the technology aside, which to me is like a big part of it, but there's certainly a big part of the interest. But what is particularly unique about crypto is that it is both, two things to highlight. One, it's an inefficient market, as we kind of talked about. And in inefficient markets, you generally have the best opportunity to capture alpha, right? And that's what I mean by like it rewards research a lot more. And the second thing is, like technology aside, is that crypto is both an inefficient market, but it's also highly liquid, right? And there's no other asset class in the world that is both inefficient and liquid. You usually have one or the other. And that's part of, from like an investing standpoint, what makes crypto also unique.
Yeah, that's fascinating. I actually really like that. I don't think I've ever really heard it described that way. You know, you talked about this idea of alpha, right? And earlier you said that you know, valuation heuristics are only useful if everyone is using them. And I'm wondering if you think those two things are kind of at odds with one another. Like, you could make the case that like a Warren Buffett, for example, was applying fundamental analysis during a period, the 60s to the 80s, when maybe other people were not, because they were just doing the Nifty 50 or whatever. And that was the difference between you know, the convergence of his expectations in the markets. Like, he was using tools which, even if everyone else wasn't using them, they still were, if not like laws of nature, they were things that were actually happening in the market to his advantage. You know, how do you think about that? Like the duality of that? Like, isn't there alpha in figuring out what the best way is to analyze something before everybody else does?
Yeah, absolutely. So to use the continue that Warren Buffett kind of example, is also in that period, you know, Warren Buffett was getting his filings through the mail. Filings as in like the annual reports for companies, right? And he was, you know, reading them. He was doing his math on a calculator and a notepad. Like, that is a very different environment than today, where like, you know, as soon as statements come out, they are immediately analyzed either by humans or AI. And even in the anticipation of releases, there's all sorts of metrics that can be tracked, credit card data, social media feeds, and so forth, to try and triangulate
this is in like equities, for example.
Yes, in public equity. So the point being that, like, in, you know, the formative years of Buffett, the market was highly inefficient.
Yeah.
Right. And it's highly inefficient because like information wasn't widely disseminated. Now the market is the market being kind of equities and traditional finance are like highly efficient, certainly far more efficient than they were decades past. Right. And information is far more immediately available and analyzable. It's not quite a word, but you understand what it means. And so applying that same analogy to crypto is, right now we're in a period where like the information is not widely available or distributed, right? You need to go hunting for that information, just like Buffett went hunting for company filings and so forth, right? And so if you can do that in a, you know, in a more systematic way and understand how these protocols work, then you stand a much greater chance to develop, to create alpha, to stand out in like the returns that you're generating, because you have a much better understanding of how these protocols work because of the information you're gathering and the analysis you're putting into that. Meanwhile, the rest of the market is mostly investing, historically on the Nifty 50 or now in crypto based on like, oh, I just think this thing is going to moon because of like, well, I just really believe in it.
Yeah, exactly. Or they're buying it, there's like the Nifty 50 in crypto, maybe not to the same extent, but, they buy the 10 largest, most liquid names because they figure that's a decent enough basket, which turns out can work some of the time, but doesn't, allow you to outperform the market, which I think is the idea if you're actually trying to, run money in the space. Sam, thinking about next steps for you, what are some of the, I don't know, the events in 2023 or the big catalysts that you're looking forward to for the market as a whole and for your, your research and what you're doing?
So market as a whole, I try and stay clear of making like macro predictions. That's not really what I spend my time kind of thinking through. I do believe, if we're thinking about kind of different protocols, the Ethereum ecosystem will continue to grow. It's proven that like the network effects are very strong. The economics that we've touched on are incredibly compelling. And so I do believe that is, Ethereum has kind of cemented itself as one of the preeminent blockchains. I do believe in kind of a multi-chain world where we'll have probably no more than a handful of prominent chain. So that means there's room for, 2 to 4 more of other blockchains. And then, so I'm spending a bunch of time understanding like what those potentially other blockchains could be. So by and large, I spend a ton of time at like the infrastructure level, understanding layer 1 blockchains. And then concurrent to that is like, how do we value these blockchains? And I've written a number of pieces on understanding the valuation metrics and conceivable ways of how to value these different blockchains. And that's where I'll continue to be spending a lot of my time.
Well, it sounds like you've got a full plate for 2023. Sam, it's been an absolute pleasure talking to you today. It's I think that's probably the most fulsome discussion we've had around your thinking and your methodology, and it was eye-opening. I learned a lot. So thanks a lot. We'll hope to have you back on the show. We can see in a year's time or 6 months' time, test your thesis about whether or not the more people who adopt a valuation methodology, the more useful it becomes, and hopefully you can lead the charge in that respect. So for those people who are listening to the podcast today, where can they find out more about what you're up to, follow you, read your stuff? Tell us.
Yeah, you can find me on Twitter. My handle is Samuel M. Andrew. And there you'll find the link to Crypto Clarity, my Substack, or if you're on Substack, if you search Crypto Clarity, it'll come up.
Awesome. Sam, thanks again. That concludes today's episode of DeFi Decoded. Sam, it was a real pleasure, and we will be seeing everybody next week. We've got a really interesting guest teed up for that, going from the investing side to the hardcore technology side, a founder of one of the 20 largest protocols will be joining us. And you'll find out if you tune in next week. Thanks a lot.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.